We're now going to talk about the Income Tax Act and the basic computation. And as I said at the beginning of these lectures, one of the mistakes that people make with tax in South Africa is they think they can know it all. If you go to America, where the tax authorities make ours look like amateurs in their level of aggression, everybody goes to a tax consultant once a year. That's considered standard behavior. In South Africa, we all like to fix our own cars, do our own divorce cases, sort out our own tax. We're very bad at outsourcing this problem. And it's something, if you're going to be an entrepreneur, that you are best advised to take it along the following lines. Say to yourself, I'm good at being an entrepreneur. If I'd wanted to be a tax expert, I would have studied tax. Be like Prof. Gordon. There are plenty of tax nerds around. Hire one and get on with running your business, which is what you're good at. Otherwise, you're going to end up doing something that you loathe. And that is the most destructive thing that you can do in a business. So please take that as being the opening shot at this. But most of you, in setting up your businesses, will land up forming a company and being a director of a company. And that brings you into that wonderful realm of Section 76 of the Companies Act, which says you are required to be reasonably informed about these matters. And that would include any decision that is related to your tax. You have to be reasonably informed. But in discharging that duty, you are entitled to delegate the authority. So what the Act is doing is it's saying to you, we'll help you with this. Okay, we will give you, go out and get help. It might cost you, but that's a cheaper way to go. And you may rely on competent employees, legal counsel, accountants, all the rest of it, providing that you took due care in their appointment. And this is where some people go wrong with this, for example, is that they rely on the advice that they get free around a braaivleis. If you get free tax advice, it's not going to help you if something goes wrong. And we'll point that out as we go along in this thing. Now, when you look at the breakdown of the South African national budget, and you see where SME or any business is going to come into play, in red is your corporate tax. Yes, you're going to have to pay corporate tax. But there are two other big danger areas in this. You will have employees, and you are required to collect their personal taxes on their behalf through the employees' tax system. And you are also required to collect VAT on behalf of government. And nowhere in all of this does it say you're going to be paid for it. That is just one of the costs of doing business. Now there is a distinction. Please, I note this very, very carefully. Your corporate tax is your tax that you must pay. And if there's a problem with your personal taxes, that's one thing. However, on PAYE and VAT, it's a different matter. There you are SARS's agent in collecting tax from the public and handing it over to SARS. And if you are found deficient in that, the charge is outright theft. And you watch all these cases of tax evaders that go to jail. They're not about their personal taxes. It's about the fact that they have failed to pay over income tax and VAT on due date. They have invaded their fiduciary duty as agent to do so. And they're facing a theft charge and a jail term. That is where most people go to jail on their taxes in South Africa, not on their personal taxes. Now, When we talk tax and how you compute tax, you must throw out of the window virtually everything that you have ever learned about accounting. Because accounting works on an accounting system to come up with a set of financial statements in terms of generally accepted accounting practice. Now that term doesn't appear in the Income Tax Act. The Income Tax Act has its own definitions for the recognition of income and expenditure. And so many people say, but my financial statement said that. It's not what's in your financial statements, it's what's on your tax return. And, you know, it's a fundamental where people go wrong, is that they think tax income and accounting income are the same. They're not. Tax is a far more barbaric form of recognition of income than accounting. It doesn't have matching principles in it. There are all sorts of different things. So what happens in the case of 99% of South African taxpayers is that they are taxed in what's called the general reduction formula. Not in terms of generally accepted accounting practice. And it's quite simply set out in the Act. It says, you will find your gross income. That is your revenue streams of the taxpayer. They are defined in Section 1 of the Income Tax Act. Then we let go some income as being exempt income. And then you will deduct from income your revenue expenditure, followed by your capital allowances if you want your depreciation rates that apply for tax, and that will give you something called taxable income. Taxable income is then applied to the tax rates that are published every year. Now you have three sets of taxpayers. Now please get this right. There are three types of taxpayers. There are companies, there are trusts, and there are individuals. They all have the same formula, overall formula to get to taxable income, but they then apply different tax rates. Three types of taxpayers, three sets of tables, which we have already visited in the first lectures of this series. So, we start off this scenario, and your tax nerds can spend months on this, with the gross income definition contained in Section 1 of the Act, and you can spend your whole life interpreting those words for just a few words of it. Now, notice that there are two parts to the section. There is one part which relates to a resident, and there is another part that relates to non-residents. They're separate definitions. Now, the fact that you might be a non-resident taxpayer does not mean that you have completely gone out of the South African tax system. You may still get caught up in it. But let's start off with the resident. In the case of a resident, the total amount in cash or otherwise received or accrued or in favor of such a resident. So what have they done? They've thrown their net as wide as they can. Anything you receive from any source, wherever it is in the world. Once you are a South African taxpayer, you are taxed on your worldwide income. Then in the case of a person who is not a resident taxpayer, then you are subject to your tax on your income that you earned in South Africa. Okay? Then they also say, but excluding receipts of a capital nature, that is, receipts that are subject to capital gains tax, which is determined in terms of the 8th Schedule of the Income Tax Act. They're just taken out, dealt with separately, and brought into the tax comp later. And then there are various other provisions that the tax nerds have to learn about, dealing specifically with individual types of income. But what are you saying? If I'm a South African taxpayer, I pay tax on all income that I've received, as wide as possible. Then we have to say, well, who is a resident and who is not a resident? Now, again, you can get awfully caught up on this. But rather go and say, there is a general term for individuals. If South Africa is the place to which you return to from your wanderings, then you are a South African resident taxpayer. So, where is my place of residence? Down Kent-on-Sea. When I finish traveling, that's where I go home. I keep the dog and the washing machine. And that is a worldwide test that we get. But what happens? There are people who have more than one home. It's often difficult to establish which home is which. So they then have what we call the default provisions, which apply to people who wander. So, if you are in South Africa less than 91 days in a tax year, you may not be tax resident, and then they have a 915-day presence test and all the rest of that. It's best put on a graphic, okay? There are all sorts of other issues there that you don't need to get involved in, which is how a person becomes a resident. What you have to do is to put it on a decision tree, and you say, a resident taxpayer is a person who returns to a place, his home is in South Africa. Notice, that's not nationality. There are a lot of people who say, it's very popular German line of argument this, I have got a German passport. That means fuck all in tax. If you live in Cape Town, no matter what nationality you are, you pay tax here. No matter what your nationality is. So, if in the case of individuals, their place of residence is first subject to a subjective test, where do you live? If that's non-conclusive, then you have a day's present test. However, if you are a company or trust registered in South Africa, then you are automatically, without doubt, a South African taxpayer. Foreign companies may be subject to taxation in South Africa if they are managed in South Africa. But that's a whole other complicated world. So if you form a company, then, sorry, there's no day's present test. If it's a South African company, it's taxable, that's the end of the story. And when we go to the day's resident test, we have this wonderful diagram, which says, if you are ordinary resident in South Africa, then you are a resident taxpayer. And then there are day counts. Now the day counts are quite exciting in international tax when it comes to things like rock stars and sports stars. Give you an example. What nationality is Ernie Els? South African is built on, right? Is Ernie Els a South African resident taxpayer? No. His place of residence is in the United Kingdom, Wentworth, UK. He's no longer a taxpayer. And he makes sure that he never spends more than 91 days a year in South Africa. Otherwise, he would be taxed on his worldwide income in South Africa. So now let's say we invite him out here to the $1 million golf tournament. And he does pay here from time to time. Does that make his earnings tax-free?
No, it's taxable in the UK, aren't they?
No, it's taxable in South Africa. It's income of a South African source. He's a non-resident, therefore he is taxable on his South African sourced income. He has to go and do one mighty tax computation in the UK, where he offsets his tax that he pays in South Africa against his tax liability in the UK. And that's for tax super nerds to do. But what we get with these international wanderers is that they put themselves, they have their home in a low tax jurisdiction. Where does nearly every Formula One driver live? Come on, guys. Is Formula One that irrelevant these days? Monaco. Why do they live in Monaco?
Tax-free.
It's tax-free. Okay? So they earn income all over the world and they pay withholding taxes all over the world. Take it back to Monaco and Monaco says, well, you don't get it. Right. Now bring it closer to home. Have you noticed how many South Africans are suddenly talking about Mauritius? Mauritius has become the new Plettenberg Bay for the wealthy of South Africa. Why? Why are they doing it?
Paradise.
It's an island paradise with a very, very low tax rate. And so now if you live in Mauritius, you've got a very low tax rate because you've called yourself Robinson Crusoe. Does that make you tax-free on your South African income? No. Your income of a South African source remains tax-free. Gets complicated. And there have been all sorts of legendary stories of people who've got this residence test wrong. There were cases with the Rolling Stones where they had to cancel concerts in the United Kingdom because if they played in the UK for one more night, they would become domiciled for tax in the UK. In the recent get-together of the police, suddenly we had Sting saying, we will rehearse in Canada. And the rest of them said, what the fuck for? He says, I'm not rehearsing in America, I will become tax resident in America. Boris Becker, the tennis star, got himself into awful trouble because he spent too many days in Germany. One night too many. He went and stayed with his sister. He didn't know what it was about. Nobody had told him. He spent one night too many in Germany, became tax domiciled in Germany. The Monty Python team have had trouble with it. But that's not going to affect you as an entrepreneur in South Africa. You're all going to be South African resident taxpayers, fully taxable. So we say, right, I'm going to be taxable on everything that I receive. Hey, aren't they going to give me a break on some exempt income? Now, when you look at exemptions in tax, they are generally related to government, charities, and a couple of other little specific things. They're mentioned in Section 10. Okay? Section 10, in its main categories, government is exempt from tax, public benefit organizations, rehabilitation mining companies, institutions, boards or bodies of professions. Very importantly, retirement funds in South Africa are not subject to tax because that's to enhance saving in retirement funds. And then a dividend in terms of Section 10(1)(k). Why are dividends exempt from tax in the hands of the beneficiaries? Because they've already been taxed in the hands of the company. Okay? So that we'll look at that. We've now got dividend tax at 20% and not 15%. It's a little bit higher. It was put up last year. We'll have that in a separate discussion. And then there are all sorts of hybrid instruments. So, what you will see in all of this is that there are very few exemptions from tax. They're very specific, and you're not going to get away with much of it being exempt. But then, after you've computed your income, then you have to claim your allowances. Now, your allowances, they are in the form of revenue expenses, those are your day-to-day operating expenses. They are determined in sections 11, 18, and 23. And they are limited by a second test, which is contained in section 23. So you have to get through two hurdles. The first hurdle is 11A, the second hurdle is section 23. So on any item of expense, your deductions are say, you may claim expenditure and losses actually incurred in the production of the income, provided they are not of a capital nature. Now your capital expenditure, you're going to have to claim wear and tear allowances on. And we'll come to that later. So you put the capital expenditure to one side and you say, is the income incurred in the production of the income. And what you've got to establish there is the expense related to my business? So I'm going to give you a very crazy demonstration of this. And it involves the clothes that you go to work in. Now you guys will see when you go to Joburg to work, if you get a job, one of the biggest expenses is going to be the clothes that you work and your cost of getting to work and back. It's massive. And you'd say, but hell man, logically, I've done that to produce income. So surely all my costs of going to work and getting dressed in smart clothes I don't even like, that is in the production of the income. And the answer is yes, it is. If you can show a nexus between your expense and your work, it's deductible. And what's reasonable doesn't come into it. Let me give you an example here. If I as a business say, I want to take my staff away for training in Mauritius, we're going to have a bit of training, we're going to have a holiday, we're going to have wonderful fun. And it's going to cost 100,000 Rand per staff member. A sales official might come along there and say, that's excessive, isn't it? You spend too much money. A sales official can't argue that. He can only say, is the expense in the production of the income? And you say, well, I don't particularly like hanging out with my staff. I want to motivate them. Therefore, the expense is deducted. Irrespective of the value of the expenditure. Forget the value, you just have to show that it is in the production of the income. You've got to create a nexus. But there are provisions which say, even though you might have this connection, there's certain expenditure you can never claim. The cost incurred in the maintenance of the taxpayer, his family, or his establishment. So, if I wear a natty suit, and I'm lekker groomed, and I go and spend the money at the malls, I do that because I want to look good at work. I can get the nexus in 11A, but in the second test, that's the cost of my maintenance. A very common example of this is the test that comes to wealthy people who have au pairs. Have any of you done au pairing, where you go and look after somebody else's kids, polish them up and so they can say goodnight to dad? Now, a wealthy executive said, I haven't got the time to bring up my kids, okay? I'm going to hire an au pair because I've got to be at work 24 hours a day. And you can see that nexus between being at work and producing income. That follows 11A. But 23A says to you that's the maintenance of the family and the establishment. Out. Expenditure denied. Okay? Then also the cost of maintaining your home is not deductible. And this leads to lots of rows about people's offices at home. If your employer provides you with an office at your place of employment, you can claim no costs relating to your home. Only if you don't have an office and you're commission based can you claim something at home. There's a specialist provision there, okay, which says if there are parts of your home that are occupied for purposes of trade, then you can claim some deduction. Okay? Then, you may not claim any deduction if it is recoverable from somebody else. So, for example, all the computer equipment here today gets stolen. I can't claim it because it's insured. Okay? Only once the insurance company's paid out, if there's still a loss, can I claim a deduction. Then, look at that. Any tax, duty, or levy or penalty imposed in terms of the Income Tax Act or the VAT Act. Now, watch this, it happens in business quite often. You now get into a cash flow crunch. You need money, and you think, I'm sitting on all that money from my VAT and from my employee's tax. I'll just borrow it from SARS for a month. And then SARS catches up with you, and they charge you a penalty and an interest charge for not complying with the Tax Act. And you say, but there is a connection between that and my business. I was trying to keep in business. They don't have to argue the case. They say, read section 23. It says, okay, bye. You will never get that deduction. And this is not the worst of it. If you have expenses incurred in producing income that does not constitute income, then it's not deductible. A good example of that is expenditure in the production of dividend income. So any expenditure that produces income which is not tax deductible for any reason, not deductible. But then this is the highlight. Item G. You may only claim amounts to the extent that they are laid out for and expended for purposes of trade. Now that phrase there has set the world alight. And it comes back again to the clothes case. And a case in the UK called Malaloo versus Drummond. She was an advocate. And she said, all these bibs and robes that they all have and that whole hierarchy in the court. She says, I don't even like these clothes. They're uncomfortable. They're scratchy. I must be allowed that deduction. And the court said, no. There's a subconscious motive in this thing, that you are warm and decently clad during the part of the day that you are at work. And that's private expenditure. Bye. We had the same case in South Africa with the doctors in Durban that wear white safari suits. Not deductible. You have to have clothes to go to work. And this provision here is terrifying. You know that Pick and Pay have been in the courts over various matters for many years. And just to show you what happened with them, because it's more closely related to business. In the Pick and Pay case, Ackerman was a member of the board of directors of the Urban Foundation in Cape Town. And he gave money from Pick and Pay to the Urban Foundation as, a philanthropic come business decision, sponsorship, if you want. And SARS came along and said to Ackerman, you can't claim this for tax purposes. And Ackerman says it's related to my business. They said, no, it's charitable donation. And it went to court, and Ackerman lost on the basis that a person doesn't change their mind by changing their hat. There was a motive somewhere in there that was not trade, it was philanthropic. Therefore, do not pass go, do not collect 200, you cannot claim the deduction. End of story. And whenever you get to this question of private expenditure in a business, what you've got to do is say, if there is a private component to it, goodbye. The expenditure is not deductible. Just watch that camera.
Yeah, we've got 2 minutes.
So, also, no deductions are granted in respect of there are special deductions relating to expenses related to restraint of trade agreements. This one's more common. Anything where payment constitutes an activity contemplated in the Prevention of Combating of Corrupt Activities Act. Now that's interesting. A bribe cannot be deducted. And that would seem reasonable, right? But if you take examples of taxpayers who've gone to trade in Nigeria, they have a game there they call fleecing. If you don't pass off some money, you'll never get a contract. And it's not illegal in Nigeria, but it is illegal here. And as it would be an invasion of the local legislation, therefore it's not deductible even if it was permissible in Nigeria. How's that for fun? So the Act is riddled with these sorts of little bits and pieces, and we've also got to have a look and say, you may also not deduct any fine or penalty imposed if you are caught doing anything in the form of a bribe or illegal activity, etc. Now, what follows on from there are a whole range of other provisions that companies have to look at, which give specific allowances to revenue expenditure. There's special provisions for legal fees, not all of them deductible. Repairs have their own provisions, so do pension and provident fund contributions, retirement annuity contributions, pensions paid to employees, research and development donations. Those are all separate standalone provisions. In your business, as an entrepreneur, your expenditure in general is going to be only in one class, 11A. That's buying all your operating expenses in. And as all you've got to do is adjudicate them between 11A and Section 23G. Those are the two big provisions that are in play most of the time. Following on from that comes your capital expenditure. Now, when is expenditure revenue and capital? The best guideline I can give you on that is revenue will be capital expenditure and subject to capital allowances if the expense will give rise to an enduring benefit. And an enduring benefit is that the expense will give rise to a benefit that lasts for more than 1 year. If a benefit asks for less than a year, then it is revenue expense. More than a year, it's capital expense. So what we have to say is that there is expenditure incurred can be revenue or capital. Capital expenditure has a range of different formulas. Revenue expenditure sits under Section 11A, okay, with its specific allowances. Capital expenditure has a range of specific allowances. So, we have allowances for fixed property. We have an allowance for rights. We have small business allowances. We have allowances for incorporeal property and other allowances. They're littered all over the Income Tax Act. So looking at them very briefly, there's even an environmental asset allowance that you don't need to know about. Biofuel allowances, you name it, they're all over the place. We have special provisions for lessees of properties. There are special provisions. If you pay rent, that is deductible if you're paying rent on a monthly basis. However, there are certain agreements where we get leasehold improvement agreements, where you agree with your landlord to improve a property. They have their own provisions to write off that improvement over more than 25 years. And if we have a lease premium, then the lease premium can be also written off over the period of the lease not exceeding 25 years. We have a provision which deals with all the other assets that you have in a business. Your cars, your computers, that sort of stuff. And there is a list published by SARS as to how many years you can write it off over. But if you have plant and machinery, it has a separate set of allowances over your other assets. So if you have plant and machinery, you get flat rates of depreciation that work on the basis of 40, 30, 40, 20, 20, 20, if it's new, 40% written off for the first year, then 20, 20, 20, or if it's second-hand goods, second-hand plant and machinery, 25, 25, 25. And then comes this animal, the small business corporation. Now that's the one that you need to concentrate on. Because if you're going to be an entrepreneur, the prize is the small business corporation. Now we've already done one comparison of that in the first lecture that we did. But what you've got to remember is over and above a preferential tax rate, then we have small business corporation assets are written off 50, 30, 20, not over their useful life. 50% in the first year, 30 in the second, 20 in the third. Or if they are manufacturing assets, they are written off 100% in the first year. Now this is the one that you need to concentrate on, and that is manufacturing assets of small business corporations are written off 100% in the first year that they are acquired. And you couple that with the 50-33-year write-off rule of all the other assets, and you say, if I've got my business in a small business corporation, in other words, the entire shareholding is held by natural persons throughout the year, gross income limitations are satisfied, and no shareholders had any shares in any other form of companies, and not more than 20% of the income was investment income or personal service income, you're not a professional service provider, you get that tax allowance. A sliding scale of tax. And that's the big one that you're going for. That is one of the biggest reasons to be an entrepreneur. Because while you are growing as an entrepreneur, you are not paying tax. That's the important point. So if I was, for example, to be a franchise owner, let's say I'm going to go and form a KFC, I don't know, Bathurst. We've got one everywhere else. First thing I'd do is I'd register it in a small business corporation. But this tax scale that we've got here is very much the cherry on the top, because it comes right at the end once you've claimed all the allowances. So what do you reckon it's going to cost me to establish a brand new KFC outlet in Bathurst? $1 million. 5 to 10. You can't get any franchise going for $1 million. So let's say I'm going to make what about KFC? Now, first question, is KFC conducting a process of manufacture? And people go, And you say, yes, it is. A restaurant is where you go in and you eat off a menu. Each item is prepared on order from the customer. KFC produces a mountain of this stuff based on their anticipated demand from their customers, right? That's a manufacturing process. The second requirement is that their raw material that they use cannot, once it is processed, be transferred back to what it was. So they're taking raw chicken, cooking it, and no man yet alive can take cooked chicken and turn it back into raw chicken. So KFC is a process of manufacture, right? So I buy 10 million rands worth of kit. Let's say 5 million of that is in the manufacturing process. All those great big kettles and things that they have there. Very expensive. So I get that as a deduction in the first year. The other 5 million of all the kitting out and all the other things that they need in the premises is written off 50% in the first year. So that's 7.5 million rands worth of allowances in the first year alone. Am I going to make 7.5 million in the first year? No way. I may have made an accounting profit. Okay? But I haven't made anything like that as a tax profit. So I take the tax loss and I carry it forward. Now this can be very, very useful in entrepreneurship, because while you are not paying SARS because of the increased allowances up front, who can you be repaying? Your debt. The design of the SBC system is there primarily so that while you are in the phase of an entrepreneurship where you are repaying heavy debt, the assets are producing enough allowances to keep SARS off your back. Only once you've paid the debts back do you actually land up paying tax. Very much the same as in the farming community. And when we get all to the end of the day, when we do start paying tax, We don't pay 28% tax rate as every other company does. There is a sliding scale of tax up to 550,000. If you compare 550,000 rand at 28% compared to the 550,000 rand paid on the sliding scale, you will find that you get a benefit of something like 90,000 rand a year just from that scale. So it's a very valuable part of entrepreneurship if you know how to use it. But you've got to form a company. You don't get that type of rate unless you formed a company. And to form a company costs money. And we've got to have consultants all over the place. And some of us don't want to do that. And that is why they have the separate aspect of the Income Tax Act, the micro business schedule, which allows you to pay tax based on turnover only. We did this example earlier in the previous slides. Okay, that's the micro business schedule that you need to have a look at. So now, when you say to yourself, first thing, I'm starting a new business. Do I start it as a company from day one? Well, it depends what sort of small business. If day one is starting a KFC outlet with a 10 million rand investment, you form a company because you want to get to all the tax incentives and everything else. However, if you are just a person who says, I want a subsistence or a lifestyle business, I don't want to be bugged with running a company and all the rest of it. I'm only going to make a couple of 100,000 pocket money. Okay? Lady wants to make a little bakery from home. I don't want all that super regulation. Then you go to the micro business way of doing things. Now all of this, it's complicated. And it's best that at the start you talk to somebody and you say, right, this is the business that I've got. What is the right animal to use from the start? And that you outsource the actual calculation of your taxes. That you outsource that to somebody else to do the actual calculations. Entrepreneurs do not do tax computation unless their business is doing tax computations. You must get on with it and make some money. So the subject this morning is understanding tax rates in South Africa. Okay? And I've put a V there. First slide wrong today. What a good start. Okay, subject is understanding tax rates in South Africa in the current political climate. Now, they will tell you that if you go to a MBA at Harvard, one of these really Ivy League MBAs, they say you got to get up at 4 o'clock in the morning so that you can be with it, with the international breaking news as it comes from the rest of the world. You will know about it first, and because of that advantage, you will get places in life. So if you got up at 4 o'clock this morning, the international news is that Hugh Hefner of Playboy Mansion fame has died at the age of 91. And the only significance of that is that his will provides that he has donated his body to science, but they've turned it down. And there's no other real news this morning. But what is of news and important is that on the 25th of October, what happens on the 25th of October? Anybody want to tell me what of significance happens in October? Answer: the medium-term budget framework speech on the afternoon of 25th of October. That is the first time that our new Minister of Finance is going to take the podium in Parliament to try and impress the international rating agencies about what is our future. Now, a lot of people think that our future rests on the outcome of what happens at the ANC conference at the end of the year. We could have melted down by the end of the year if Kagame doesn't manage to pull something out of the barrel to tell the international rating agencies about South Africa on the 25th of October. If he doesn't impress, and we get the final downgrades to junk status on all fronts, that will have an enormous prospect on what happens in the future. Probably even more of a prospect than what's going to happen in December, because the latest word seems to be that the conference of the ANC is going to be delayed while they get their house in order. So that day is going to be pretty impressive. And what we need to find from that day is what is the story. And this will lead to where your tax rates come from. And your tax rates come from your population growth rates. There's a link between the two. Let me explain it to you like this. We compute taxable income. We did that in the last lecture. But then the big question is, what is the tax rate that is applied? Now, if you go to Mauritius, why can Mauritius have such low tax rates compared to South Africa? 3%, if you're unlucky, no more. How do they get that right? When we're looking at a top tax rate for individuals in South Africa, 45%. And the answer is, only 1 million people live in Mauritius. It's tiny. So when you've got nobody living on an island, you don't have to have a massive tax base to support them. So Mauritius is the financial capital of Africa, or so some people say. But they've got a tiny population. If you take Namibia, we have the Namibians, there are only, 2 million Namibians in total. And the country, okay, it's desert on the size of South Africa, almost. So very important is your population size versus your economic size. And our economy is struggling. What happened in that slide on the board was that we fell in a hole in 2009. And the international economists said, don't worry, there will be a very quick recovery rate. It will be a V, down and up again. We will be trucking at world growth rates of over 4% by 2012, or so they said. And so the politicians tried to say, well, don't worry, this is just a blip on the radar screen. We're not going to restate all our thinking and our delivery programs and everything else because of the world financial crisis. We'll borrow our way through it. Especially in South Africa, where there isn't a word in all 11 official languages for austerity or cut back when economic times are difficult. So Gordon, who was finance minister, said, I'm not going to change my game plan. But then what happened? Well, a year later, it was on track. The recovery was in process, and then it went boom. So it wasn't a V. Then they said it would be a W, like this. And that didn't happen. And right now, we've just recovered from a little recession, or so we think. The growth rates haven't come back. And I'm going to explain to you that in tax rates, economic growth rate compared to tax growth rate is very important. So we go like this. Thomas Piketty, he's not even 50 yet. He is the rock star economist of the world because of his book, Capital in the 21st Century. And he came out to South Africa 2 years ago, and the whole front row of his lectures were occupied by ANC officials. Give us a miracle, Thomas, please. We need your help. And Piketty said, I can't really help you because my work is based on what happens in Europe and America. And you have some fundamental differences that you have to deal with in South Africa, particularly your population growth rate. So, Trevor Manuel's prediction in the National Development Plan, there you have it, is that the population would level off at 60 million. That was made at the height of the AIDS pandemic. But that hasn't happened. Our population growth rate is growing like never before. 700,000 added to the population every year. And by 2030, there will be 6 to 8 million more people in South Africa than we've budgeted for. And we've got to pay for them. Most of them are dead poor. So, if you map then your population growth rate versus your economic growth rate, you will see that prior to 2009, we were making progress on our population growth. Our economy was growing faster than our population. But now, we've got limited or zero growth, but the population is growing at 1%. And what Piketty will tell you is he will say, so long as you are growing at more than 1% above your population growth rate, hey man, that's cool. But that's not happening in South Africa. So Piketty can't help us. So we have to borrow. That's why we carry on and on borrowing. We're borrowing because we have to service for more people with a tax collection that is not growing at the same rate. You see why that creates the prospect of increasing tax rates. And this was put to Parliament, Standing Committee of Appropriations on 15 February. They said, your National Development Plan said 600,000 new jobs every year. You're only able to make 250,000 jobs a year. Therefore, you have a job problem, particularly amongst the youth. So, a matric on a national average in South Africa has a 50% prospect of getting a job. A graduate has a 75% prospect of getting a job. It's one of the reasons why you go to university is job prospect and earning prospect. So, we say, well, we're not doing that. But on top of that, other problems emerge. Now, this is a factor you should keep your eye on, is tax buoyancy, how tax floats. Now, if you look at the line of 1 there, you can see that in 2009, our tax collections plummeted as the economy plummeted. Then they came back, and our taxes were growing faster than our economy right up until mid-2015. Everything seemed to be okay. We were holding it together. We had our nose above the water. But you can see in the right hand there, part of the slide there, that the tax buoyancy ratio has started to fall. For some reason, tax is not growing faster than the economy anymore. And nobody really has an explanation as to why. There can be various views from various people on this. So you go like this. Gordon comes along in his last national budget speech, which was on the back in February. And he said, I've got bad news here. We have a budget for this year, which is 20, and we are going to miss that by 27 billion rand under-collected. And he said, to that must be added the 10 billion downgrade that I put on it last October. So in all, South Africa missed the boat on its tax collections by 37 billion rand out of 1.3 billion that was predicted last year. Now, that's a problem, because we normally get to within 10 billion or so of the budget, if not exceeding the budget. And that was the gloomy picture which he painted on Budget Day. On the 31st of March, Gordon was fired on the end of the tax year. So we didn't get the final measurement for the year. 3 days later, Gigaba, the successor, and Manyani, the commissioner, had a press conference, and they said, don't worry, we've made budget. And everybody said, what? No, we've made budget. What they were saying is, they had made the budget, the downgraded budget, this 27 billion downgrade budget,
but they haven't made the budget for the year. So South Africa has a hole in its tax collections. And to date, it hasn't changed its strategy for that hole in the tax collections. That is what you're going to hear about on the 25th of October. What are they going to do about this hole that they haven't budgeted for? Because in this year's national budget speech, they said, we're not compensating. We're having the usual increase in tax collections. So now look what happens. Personal tax will be increased by 16 billion rand a year. We will get some other little ones, but mainly it's all going to fall on personal tax and cigarettes, etc. Notice that one of the people who is most in line for tax increases is the personal tax collections, which have now reached nearly 40% of total tax collections. Now, take that further. Events of March 2017 are a culmination of what's been coming since 2010. And it doesn't matter who is the Minister of Finance, the problem remains the same. Okay? And what we look at is that they say, now look at the taxpayer. Who amongst the taxpayers is going to pay the additional tax? Okay? And the game of financial planning now goes through the roof. We've got to say, if you are a personal taxpayer, you've got to pay attention because you're now in the line for increased tax collections. We have to watch out for personal tax increases. So if you look at South Africa's sources of tax, in the orange line there, do you see how the contribution from personal taxpayers in orange is growing every year in proportion to the total, while company tax collections are dropping slightly in blue, as the economy is not growing. So what are we going to do about it? Well, if you look at it, back 10, 15 years ago, Maria Ramos, who was head of National Treasury until she became head of ABSA, she said the ultimate contribution from personal tax should be about 34%, which it was back in 2012. By 2016, that has grown all the way as corporate tax collections have fallen, and we will, by next year, hit that the individual is paying 40% of the total tax pie, as companies pay less and less. And then we see, well, where are they making up a bit? Well, the big thing that they made up a bit, and the one success story that they've had, is capital gains tax, which has been increasing over the years. And we have to say, we need to look at what is capital gains tax as well in this debate, because that's also becoming a major part of the story. So, now I can tell you that this will be in every exam I ever set. The most important slide in tax are the types of tax and how they work together, not the definition of gross income. So most tax courses will start with, Later Khan was a wine farmer. That's about received or accrued in the definition of gross income. Okay? And we sort of say today, well, so what? We know that. What is the most important thing is where is the tax rate at the end of the day going? Now this we can summarize as follows. Let's take an imaginary fellow and call him Mark Shuttleworth. Has anybody heard of him? Okay, South Africa's billionaire IT guru. Very clever man. Okay, made a brilliant IT business, sold it to the Americans and insisted on being paid in cash. So it didn't evaporate like most people's shares did in the NASDAQ bubble of 2001. So he got paid. 3 billion in cash. And at the time, South Africa did not have capital gains tax. The time that he did that, it was back in 1996 or so. So he didn't pay dividend tax either. He didn't need to. It wasn't allowed. We didn't have it at the time. So Shuttleworth pocketed 3 billion tax-free, and he blew himself off into space. What's $20 million in that context, which is what it cost him to do. But we will see in a minute that if the same gain was made today, he'd lose a third of it in tax. And we could send the entire Gupta family up into space. And so you have to look at the evolution of tax. And the way that you explain this is you say, in tax, there are 3 entities you can choose: company, trust, individual. Okay. Now, each one has its own tax rates. So, capital gains tax was installed in 2001. They said, we'll be very kind and we'll have only tax part of the capital gains. That, over 15 years, has now moved to 80% of the capital gains of companies are taxable. 80% of the gains of trusts are taxable. But when it comes to the individual, only 40% of the gain is taxable. So now, in old company terms, we used to say to people, when in doubt, form a company. Does that hold from a tax perspective today? No. From a CGT profile, the lowest profile is the individual, not the company. So then we get the tax rates. And the top rate of tax for an individual has now reached 45% versus the company tax rate of 28%. So now we are saying from a headline earning rate, 28% is much better than 45%. So in that respect, you'd like to have a company. But one of the reasons why you try to keep the company tax rate low is to try and encourage companies to take their profits and reinvest to create more employment and more tax base. So the 28% then only exists if the company does not declare a dividend. If you declare a dividend, 20% dividend tax is then applied on dividends paid to individuals. So you've got to take all of these taxes and put them into a little lethal cocktail, right? Which is the best way to go. So, if you were Mark Shuttleworth and you sold out today, 35% capital gains tax compared to 0 years ago. And on their revenue, their current profits, they're paying 40% if you include dividend tax. So there's not much of a difference between the after-tax dividend of a company and the top personal rate of tax. Now, in years gone by, when you met the Cape Town socialites, they would say, me and my wife are directors of our family investment company. And you would say, that's very interesting. Why do you do that? Are you trying to get some sort of social award for paying too much tax? Why would you want to pay twice the amount of capital gains tax? Now, it was fashionable to have a company for family investments 20 years ago. Just because of the change in tax rates, that's all changed. Right. So we move across then from from Cape Town to Durban. In Durban, there are more trusts per square kilometre than anywhere else. It would seem you have to have 3 before you can send your kids to the local private schools. I don't know why. And they'll come up and say, no, we don't use companies, we use trusts. And you say, well, that's very interesting, because trusts are used for investments, and when investments are sold, there are capital gains. 36% tax rate. Or 45% flat rate on your revenue income. Why would you want a trust? Surely what you're wanting in South Africa today is the individual rate. Now, what they will tell you in response is that they've got very clever accountants. And it is possible to get the income of a trust taxed in the hands of the individual, which gives the lower tax rates. But that defeats the secondary purpose of having a trust, which everybody will tell you is to avoid estate duty. If you cause the income to be taxed in the hands of the individuals, you're going to lose your estate duty saving. So what you are looking at the bottom is that having all of these structures in place doesn't really help you. But when it comes to, I'm starting off as an entrepreneur, and I'm bigger than the turnover tax threshold of 1,000, then you turn around and you say, sorry, I don't get turnover tax, my turnover is over R1 million. If I use a company, the highest tax rate is 28%, provided I keep my profits in the company, if I'm growing, which is what an entrepreneur is supposed to do. And I will get even better tax rates if I manage to register myself as an SBC. So the company is king for the entrepreneur. But it's going to cost me the money to keep it going. All the administration and everything else that I've got to go through to do that. And this is why there is that very important part at the big choice. Are you going to keep as a micro business, or are you going to set your business up formally as an entrepreneur in a manner that can grow? And that's a big trade-off between the cost of compliance and the tax saving that you are actually going to achieve. So we move on from there and we say, now let's talk about personal tax. Where is personal tax going in South Africa? Now, the wealthy taxpayers, the top million taxpayers, are in light blue in that graph by number. But they pay, in the right-hand column, 63% of South Africa's income tax. And you've got to say, as a student of tax, that's where I want to live one day, in that block. Well, here's some news for you. Let's talk about personalities and tax. And we say, right, there are the tax tables. Tell us about the sentiment of the politicians behind the personal tax rates in South Africa. And we bring in a first character, Nene. Do you remember? He was the Minister of Finance after Gordon for a couple of years. And then suddenly we woke up in December 2015 with him fired overnight because he said no to the president. Now, he was following the advice of the World Bank. The World Bank said, you give tax breaks as wide a scale as possible to everybody. If you want to increase tax collections, you go for the lower end income earner to make them pay a little bit each because there are millions of them. Going for the higher end taxpayer doesn't work because there's so few of them. So Nene was there and he was sent packing. We then got another chap for 3 days, and he didn't have time long enough to tell us what he thought about personal taxes. And by Christmas time 2015, PG's back in the seat. How's it, PG? Been gone for 2 years. What you been doing? He says, I've been reading Atkinson. Oh, have you been on a diet? No, man, not Atkinson the dietitian. Atkinson, the economist, the leading thought maker on inequality. He is actually a predecessor of Piketty. And he says he's got no time for the rich. We must restore inequality through higher tax rates. So Gordon, in his first budget back in 2016, said, I look after the lower end of the scale, and the higher end of the tax scale can go and whistle. We are starting to get redistributive in amongst personal taxes. And in February this year, Gordon says, right, now I'm talking business. I've been loading up on more Atkinson. And what we've got now is that I will give some fiscal drag adjustment, but I'm now going to tax the really wealthy on even more. So now we say, who are the real wealthies? And we say, right, there are the tax numbers for South Africa. There are 13.9 million South Africans who are registered as taxpayers. But don't let that impress you, because 6.5 million of them don't earn enough to pay tax. They are below the tax threshold of 75,000 rand a year. So discount them. That's 7.4 million. Then we say, 6.3 million are earning between 70,000 rand a year and 500,000 rand a year, and they pay 38% of the tax. But that's not what the wealthy are. The wealthy are classified in South Africa from those who earn above about 500,000 upwards. And there are only 1 million of them in the whole country out of 56 million. But what's fascinating in that is that we say there is this new band of tax. Those who earn more than 1.5 million rand a year are now paying a 45% tax rate. But in the whole country, there are only 103,000 of them. And by the time you get to taxable income of 4 million rand a year, there are only 4,000 of them in the entire country. So we have this enormous disparity between some incredibly wealthy people. It doesn't matter what tax rate they pay anyway. They've got so much money we could never tax them out of existence. Okay? But the problem is there are not enough of them. What we have is a problem. We need to grow more taxpayers. Now, what does this say to you if you are an entrepreneur? It says if you are a small survivalist business, tax is no issue to you. You might have to do turnover tax. But if you are earning between 70,000 and 500,000, then you see that, okay, initially it doesn't hurt, but the rate goes upwards towards 40% on 500,000. The danger is, for those who earn between 500,000 and 1.5 million, they're already paying a 40% tax rate on that money, whether it's 40% or 45%. It hurts like crazy. So now you go out and you get a job. And this is where it becomes relevant in the debate of intrapreneurs and entrepreneurs. You are entrepreneurs who want to own your own business. Intrapreneurs want to go and get a job. So if I'm an intrapreneur and I go out and I land a job with R1 million salary, what tax planning opportunity is there for me? My pension fund contributions. Because employees cannot claim tax deductions in terms of Section 23M, except for a very few items such as their pension fund contributions, etc. The business is not limited by Section 23M, and they go straight to Section 11A and say, is this expense in the production of the income? So now I'll give you an example of what happens in, for example, my life. I have two lives. I work at the university. I also consult with my clients. If I took you all across the road and said, let's have a piss up at the Rat, and I paid for it, can I claim that as a tax deduction? No. That's related to my job. Even though there is a nexus between the two, I can't claim entertainment expenses. If I go out to business with a client, out to dinner with a client, and we have an enormous piss up with tequilas and everything else, I can say that's client entertainment. And I can reclaim the whole lot. You see how it differs? So you get a tax advantage as an entrepreneur. In that respect, super. Now, just to show you what the future prospects are on tax, this table here is a table of the predicted tax rate increases that will come in to increase national health insurance if we ever get it. We're arguing about this at the moment, but will it be a payroll tax? In other words, an increase in your monthly taxation? Will it be a surcharge on your taxable income, or will it be an increase in value-added tax? And whatever scenario you see, you say tax rates are going to rise steeply with the national health implementation if it ever comes. But even before that, tax rates are going to have to rise, and this will probably be announced on the 25th of October, when just to make up for the hole that is already in the tax system. So you have to watch the tax rates very carefully as to where they're going. Just to explain a concept that might be interesting to you, to add on to the end of this, in the context of fees must fall. How many people say free fees for all is the way to go? If you look at that graph, those in yellow are those who are not at university. They're not at university not because they can't afford it, but because they haven't got admission criteria. They haven't got a good enough matric. Those in green are those who are at university, and those in red are those who have achieved a university admission requirement, but are not at university for one reason or another. There are 10 columns there. Those are the 10 income deciles of South Africa, from poorest to richest. Now let's talk about it. Decile 1, the poorest of the poor in South Africa. None of their kids are at university. Why? Because they didn't get the admission requirements. That is a reflection on basic education in South Africa. Right-hand column, that's the top 10% of South Africa. Wealthiest 10%. 57% of the student intake is from the wealthiest 10% of South Africa. But why? They qualify to get to university in the first place because they've been to better schools. All those in yellow, I emphasize, cannot get to university in any event because of their schooling. So then we get to this debate about education in South Africa and the missing middle and all the rest of it. Atkinson, the economist we spoke to about earlier, he came out in 2007, and he said the top 10%, and this is in 2016 terms, earn more than 150,000 Rand per year. Then you are in the wealthiest 10% of South Africa. To be in the wealthiest 1% of South Africa, you earn more than 600,000 Rand per year. So if you look at most of us in this room, we've got bragging rights compared to the rest. And there is a huge problem with this, not only in how do we afford university, how do we get people to university, and all the rest of it. It's what do we do with the millions of South Africans who never have a prospect of going to university anyway. Because, and therefore they do not have a prospect of earning higher income, etc. In amongst this, we need to say, if you are rich in South Africa, your job is to pay your taxes on time, all the time. Otherwise, you face the wrath of the Tax Administration Act, which we started working on in the last lecture. In that act is a table of penalties, which we will discuss again later today. And you will see that these are the penalties for tax evasion. Just mark this in your mind now. There are various categories of penalties comparing to various different offences. If you get caught in South Africa evading tax, you will pay penalties plus interest plus the tax back. You will pay back double. We'll talk about that a little bit more under tax administration. So, most of the class are on a good wicket here, aren't we? What we're looking at and what we're saying is, get some sleep, bacon and eggs for breakfast, You're in the privileged part of South Africa, good luck. But what you're saying in amongst that is that if you are going to live in South Africa in the next few years, tax rates are probably going to go up a hell of a lot. If you are employed, there's nothing you can do about it. Your employer will take that tax from you and pay it over to SARS. Entrepreneurs can do more about it. They're very fortunate in that respect. That's one of the advantages of being an entrepreneur. But for goodness sake, get it right, because if you get it wrong, then you are going to be in for a miserable time with your taxes.